Welcome back. Today I am speaking to you from downtown Arlington, Virginia, just across the Potomac River from Georgetown University, and off in the distance I can get a glimpse of the nation's capital. They say there's two things that you'll never want to see being made. That's sausage and laws, so I am staying away from the capital area this week. I'll start reading your reflection papers on Monday. I'll grade them in the order that I reviewed them, and I'll release them immediately so that you can take a look at them. Make sure to open up the rubric and hover over the blue bubbles so that you can read my comments. Over the next 2 weeks, we'll take a deep dive into the balance sheet. As we discussed last week, the balance sheet is based on the fundamental accounting equation, assets equals liabilities plus owner's equity. The balance sheet cannot be looked at in a bubble, though. It is connected in many ways to the income statement, so it's important that to understand the connection between the two statements before reviewing them. The first thing we need to understand is that there are two primary accounting methods in North America. They are the cash and accrual accounting. Cash accounting reports income and expenses in the year they're received and paid, or in the period that they're received and paid. Accrual accounting reports income and expenses in the period that they're earned and incurred. We'll be looking only at the accrual method of accounting in this class. There are four fundamental accounting concepts that we also need to be aware of. The first is the one that we talked to, accrual concept. Revenue and expenses are recorded when they occur, not when the cash is received or paid out. Second is the consistency concept. Once an accounting method has been chosen, that method should be used unless there is some sound reason to do otherwise. The going concern concept says that the business entity for which accounts are being prepared is in good condition and will continue to be so in the foreseeable future. The conservation concept is that revenue and profits are included in the balance sheet only when they are realized or there is reasonable certainty in realizing them, but liabilities are included when there is a reasonable possibility of incurring them. And then we have the matching principle that says that transactions affecting both revenues and expenses should be recognized in the same accounting period. As I said, the balance sheet and income statement are very much connected. A sale increases an asset or decreases a liability, and an expense will decrease an asset or increase a liability. We'll come back to this after we've reviewed both the balance sheet and the income statement, but think about this now as you begin your deep dive into the balance sheet. In this week's lessons, we'll study assets. The important thing to understand about assets is that they are sometimes stated at the actual or market value and most often are not on the balance sheet. When you recast the fundamental equation to read assets minus liabilities equals owner's equity, you quickly realize that the balance sheet is not a fair representation of an owner's investment. We will come back to this point over and over again during the two measurement classes that you'll be taking in your MBA program. The way financial analysts deal with this problem is to identify asset value as book, what the accounting records say it's worth, and as market value, the price an asset would fetch in the marketplace. In banking, we take a customer's balance sheet and review the book net worth or the owner's equity, and then we'd adjust the asset and liability values to account for inventory methods, collectability of accounts, related party receivables or liabilities, subordinated debt. We'd add these things back and we'd come to what we'd call tangible effective net worth. That's what we thought our borrower would be worth in a lending situation. Sometimes we'd further adjust these balances to come up with liquidation values. The reason I bring all of this up is because it's important to recognize that the value of assets on a balance sheet may or may not reflect the true value, and it's also based on the perspective of the reviewer. An owner may find value in assets knowing that he or she can generate income. A banker may find value in these assets as collateral basis that they can lend again. And a potential buyer of these assets may find value in the future benefit stream they can provide or in the liquidation or cash that they could bring in a liquidation scenario. As you read, you will learn about the types of assets and how they're presented and classified on a balance sheet. This is important to understand as this is the format that you will use going forward to review asset value. But as you read about this, think about the difference between market and book value and the perspective of the value and the company strategy and how these concepts will affect the value of an asset. I've also included an article on inventory methods since this is a subject that a lot of people just simply don't understand. In this week's discussion board, I want you to think about one asset in your company that generates the most income or is key to your company's strategy. First, consider how this asset may be represented on the balance sheet. Second, discuss whether this value on the balance sheet is really representative of the true value of the asset. Consider what the market liquidation or other value may be that is connected to that asset or the market value. Third, what accounting principles are applied when considering the value of your chosen asset? And that would be the 4 or 5 concepts that we discussed earlier. I tried to answer each of your initial comments on the discussion board just to get things going. I won't be that involved in the future. Let's call it the DB going forward just for simplicity's sake. I've really enjoyed interacting with a lot of you and hope to continue that. But we can also use the Ask the Instructor question for something more general in nature, I should say. And for issues that you prefer to keep between you and I, you can always email or text me, and I can follow up with a phone call or video chat if I feel that's necessary. In the meantime, have a great week.